Swayam Prabha. Digital India. Educated India.
Hello, Namaste. I am Dr. Diksha Munjal Shankar. I teach as an assistant professor at the Faculty of Law, University of Delhi. So today we will be discussing the 7th lecture in this series, wherein we will be discussing profits and gains from business and profession. So we have covered 2 heads of income up until now, the head of income from salary and the other one is income from house property. So today we will be discussing the charging section for profit and gains from business and profession, which I will abbreviate and refer to as PGBP. So we will be looking at the charging section of PGBP, which is section 28. Then we will be looking at the applicability overall. What are the deductions which are available under the head PGBP? How do we find out whether a particular expense can be considered as a bad debt or not? Then we will be looking at business expenditures, when do we allow them? And then we will be looking at the tests of distinction between capital expenditure and revenue expenditure or business expenditure. So there are profits and gains from every business and profession. And the way we say that there is income which is both positive and negative, we also have gains which are positive or negative. Or similarly, we can say that there are profits which are positive and negative. Now, what are positive gains or positive profits? Wherein you actually have some sort of a profit in the positive sense. But when it is in the negative sense, we see it as a loss. So when we talk about business and profession, we talk about business from all points of view, in the sense that we do not really look at whether or not the business is momentary, occasional, seasonal or perennial. So let's say, for example, you want to start out with a particular business, but you realize in 2 months' time that you cannot carry on with this business. And for the 2 months that you have carried out the business, you have hardly sold your goods, you've hardly been able to secure clients or, sold your goods or services. And therefore, you now want to shut it down. So your business is not something which has been there in continuity, right? So it's been like an occasional thing. Or you might be engaged in a business wherein your business is of seasonal nature. So for example, you want to sell woolen clothes, or you want to sell a particular harvest like mangoes or cherries, right? So all of these will require you to carry out your business in a very seasonal manner. You cannot carry out the business of selling cherries throughout the year. Why? Because you cannot harvest them. Similarly, you cannot harvest mango throughout the year. You cannot sell woolen clothes throughout the year. Right? And therefore, for taxation purposes, we do not really look at, or it is not of any significance whether your business is of momentary nature, occasional, perennial or seasonal. Likewise, in case of taxation, we are not even concerned with whether or not the business is a legal one or an illegal one. So this might be something very interesting for you, because even in case of an illegal business, and for that, of course, you need to be caught. If you are caught, then for the illegal business that you've been carrying out, for example, smuggling. So once you are caught, you will be liable to pay tax even on the profit from that smuggling, besides the penalty, etc. That's another thing altogether. So your criminal prosecution goes alongside you paying tax on whatever gains you have got through that illegal business as well. Then your business transactions could be singular, could be frequent, could be numerous. Again, none of that is of any concern for the purposes of taxation. So if you see whether your business is something that you've just started out with, or it has been there forever, or you started and stopped it immediately, none of it matters. Everything gets covered and everything is liable to be taxed. So when I say this term business, I would also always include the term profession in it. And I will be using it either interchangeably or together. So it also includes income from profession. Therefore, if you have a degree, technical skill or technical knowledge which you use to render services and earn, the money which is so earned will be subject to tax under the head PGBP. So the charging section of PGBP is section 28, which again, as I reiterate, means that in case section 28 was not there in the Act, then any profit, any gain, whether positive or negative from any business or profession which would have been there, that would not be subject to tax. So section 28 is the charging section. So section 28 provides that if there is any profit or gain which is arising from business or profession carried out by the assessee in any point of time in the previous year, that would be subject to tax. So like we said, if there is any profit or any gain, and it can be at any point of time in the previous year, it does not matter. So even if you've had one transaction in the small business that you ran for 2 months, it doesn't matter. That one transaction would also be subject to tax. Then next is in case of export assessee. So if you are an export assessee and you get some sort of a profit on sale of your import license. So import-export people usually have these import licenses, wherein they are able to import some fixed amount of goods, right? So when they import those goods, and let's say for example, you could import, let's say goods which are up to the limit of 50,000 pieces, right? Now, let's say for example, you stop at 20,000 because either there's not enough demand in the market, so you don't want to procure more and sell more, or for maybe the possibility that you want to discontinue your business, right? So now you have that margin of 30,000, and those 30,000 pieces license still remains. So what do? For you, it has possibly become useless. So you will go and sell out your license. And then when you sell out your license to somebody, you are going to get money in return. And that money in return is nothing but your profit on the sale of your import license. So that money that you're getting, which is coming through as profit as a result of the sale, that will be subject to tax under the head PGBP. Then you've got duty drawback, which is again all part and parcel of import-export business. Then you've got cash assistance. So in case of cash assistance, the government sometimes gives you some amount of cash assistance for you to be able to carry out certain import-export transactions. And finally, you have duty entitlement passbook. So duty entitlement passbook is, you can draw an example of your bank account passbook, right? So in a bank account passbook, there is always going to be some credit and some debit, right? Over here also, in case of duty entitlement passbook, you have got inflow and outflow of money and inflow and outflow of different sort of transactions which are there with respect to your business, right? Now, once you reach a particular limit, etc., and now you no longer want to continue with the business, or there is enough margin, it is of no use to you, and then you go ahead and you sell out that margin part, that would also be entitled to be taxed under the head PGBP. Third is the value of any benefit or perquisite which is arising from business or exercising of profession. That is also subject to tax. Next is your keyman insurance. So keyman insurance we looked at from the point of view of salary, if you recollect in the previous lecture. So when we looked at keyman insurance under salary, that was one part of it. And now when you look at keyman insurance, you can also see it from the perspective of business. So when we talk about this keyman insurance from the point of view of PGBP, over here what happens is that because the employer has taken insurance on your part, right, and let's say for example, you as an employee are no longer there tomorrow, either let's say on account of your cessation of employment, because maybe a competitor has poached you, right? So you're not going to be there in this business. They've poached you for a higher salary, better perks, etc., and you leave the enterprise. Now, because that void has been created, the employer is going to get indemnified against the keyman insurance that the employer has taken, right? So when that money comes to the employer, that is nothing but PGBP in the hands of the employer. Similarly, we will look at keyman insurance under income from other sources, right? So we will discuss scheme and insurance again when we look at income from other sources. So the next is any salary or bonus or commission or any other remuneration which is received by partners from the partnership firm that is subject to tax under the head PGBP, and whatever income is coming into the hands of the partners, that will go under the head PGBP. So if you recollect, we had discussed that when we were looking at the head salary, we were talking about directors of a company. And in case of directors of a company, I told you that there must be an employer-employee relationship. And at that time itself, we had a heads up on partners in a firm, right? And I told you that because there is no concept of employer-employee relationship in case of partners, and yet they are able to get a profit and gains from the business or partnership, whatever they are running as a result of that partnership, the money that is coming into the hands of the partners, that is subject to tax under PGBP and not salary. Next is any compensation which is due to or received by any person on account of 1. The termination or modification in terms of a contract relating to any Indian company or another company. Now let's say, for example, you have contracted with, you are A, you have contracted with B, right? Now let's say, for example, you were supposed to supply 10 bags of wheat, okay, at the rate of, let's say, 100 rupees per bag. Now you were supposed to supply this to B and B was supposed to pay you for that. Now you are no longer able to supply it at the rate of 100 rupees per bag. Why? Because probably suddenly there has been a drought, the prices have shot up, and because the prices have shot up, you cannot sell it for anything less than, let's say, 150 rupees per bag. Okay. So now when you are not able to sell it for anything less than 150 rupees per bag, B at this point of time has the option either to ask you for compensation. Why? Because apparently there has been a breach of contract, right? Or it can simply say that, well, I am going to terminate the contract again because there is a breach of contract, right? Or they can actually modify it and say that we are still going to carry it on. Okay. So when B has this choice either to seek compensation or make those necessary modifications and still carry on, at that point of time, there is obviously going to be some sort of compensation which is going to come in the hands of B, right? When you are going to compensate B, that amount which is falling into the hands as a result of either compensation or compensation either for the termination or modification of the terms of the contract, that will go under the head PGBP. Next is termination or modification in terms of a contract relating to any Indian firm or any Indian agency. So the first part that we are talking about is any Indian company. Next we are talking about any Indian firm. But essentially we are looking at the similar example, right? And when we talk about any other company, we are essentially talking about a foreign company. Okay, so over here we are talking about Indian firm, Indian agency, Indian company or any other company, i.e. your foreign company. And finally, you've got vesting of management in favor of government or government authority or corporation, etc. So let's say, for example, you have got a government company, right, which is not doing too well. And because it's not doing too well, maybe its competitor, which is a private company, it approaches that private company. Okay. Now, when the government company G approaches the private company P and says that, well, we are not able to keep our business afloat, can you help us? So the private company says that, okay, fine, we will help you out. And for that, we will send out 10 people, right? Now, when this private company P sends out 10 people to this government company has to obviously compensate and will pay a hefty amount to the private company. Private company is obviously going to charge them a huge amount. Why? Because private company is sending out its top people to the government company, and that too its competitor, right, to help them keep their business afloat. So when you are going to send out these 10 people to the government company, you are going to vest your management in favor of that government company, right? And as a result, the money that you receive as the private company, that money that will be subject to tax under the head PGBP. Next is any compensation due to or received by any person for not carrying out any business activity or professional activity in India, that is non-competitive fees. So let's say, for example, you are running a particular business, right, together with another person. You are X and the other person is Y. Previously, you were working together, right, and now perhaps you have parted ways. Or let's say, for example, you do not want company Y to enter into the same market that you are in. Okay, so let's say, for example, you are selling pencils and you are doing extremely well. You come to know that Y also wants to sell pencils, and at that point of time, to be able to stop Y, what do? You give out some money and tell Y that please do not enter into the market. Okay, so when you are doing that, when you are trying to stop this person from carrying out that business activity or professional activity, and you give out some amount, that amount that Y receives, that is nothing but an income that will be subject to tax under the head PGBP. Next is when you receive any compensation for not sharing your know-how, patent, copyright, trademark, license, formula, or such type of commercial rights. So where there is IPR involved and you are getting some compensation for not sharing this intellectual property, then obviously that will also fall under the head PGBP. Then you've got any sum which is received from the transfer or destruction or demolition of any asset whose cost has been allowed as deduction under section 3580. Then we look at section 29, which provides for computation of PGBP, that how do you compute this income under the head PGBP. So section 29 is quiet, right, and it says that okay fine, do you want to understand how do you compute income under PGBP, and then it very nicely says that you need to move and look at sections 30 to 43D, and that's all that section 29 provides. So essentially, if you want to understand how do you compute income under PGBP, you will have to look at sections 30 to 43D. Now section 30 to 36 talk about deductions, and these deductions, again, like I had pointed out in the previous lectures, these deductions are particular only to this unique head of PGBP. So section 30 talks about revenue expenditure on building. So when we look at revenue expenditure on building, we are talking about a building that we are using for our own profession or business, right, which is being run by your own self, and any expense that is incurred on that. So expenses which are of the nature of repair and maintenance, rent, rates and taxes, insurance premium, if you can actually show that they are of revenue nature, then you get the deduction. But if you are not able to satisfy that these expenditures are of revenue nature, then you will not get the benefit of any deduction. So we will look at what is a expense which is of capital nature or revenue nature, and then you will get clarity about what we are discussing here. So we will look at that in the next few slides. So section 30 says that they must not be of capital nature or personal nature. Section 31 says that revenue expenditure on plant and machinery and furniture and fixture which is used for one's own business and profession can also be sought for deduction. So everywhere you see this term revenue expenditure come in, right? So when we look at building over here, building will mean any building, right, that you're using for your business or profession. When we talk about plant and machinery is what you understand that, if you've got, let's say for example, a factory, you are carrying out the business of converting wheat into wheat flour, right? And to convert wheat grain into wheat flour, you have to put it through a particular process. And for that, you will have to install some plant and machinery in the factory. So that is what is referred to as plant and machinery in the normal sense. But sometimes this plant and machinery can also take a different form in the sense of professions, right? So for example, you've got lawyers. Now, where do you find lawyers having plant and machinery? For lawyers, plant and machinery are nothing but their books, because without that, they will not be able to function, right? Then you've got this concept of furniture and fixtures. So furniture, I'm sure all of us understand, but the moment we pick up this furniture and fix it to the ground, it becomes a fixture. So if you go to a cinema hall, you will see that there are many seats lined up. But those seats are not ones which you can just pick up and then move to the front row or the back row, right? So that means that they are fixed over there. So if those seats were one that you could pick up and move around, that would still constitute furniture. But the moment you fix it to the ground, it becomes a fixture. So if there is revenue expenditure on plant and machinery and furniture and fixtures, which you are using for your own business and profession, then you can seek deduction on that. So section 31 allows only expenses on repair and insurance premium for deduction. Expenses which are incurred on account of rent and rates and tax can be allowed only under section 37. Then we look at section 32, which talks about depreciation. So depreciation is something that is taken into account when you're talking about accounts, right? And you calculate depreciation on different kind of assets. So with respect to tangible or intangible assets, depreciation shall be allowed to the owner or fractional owner of the asset by using the WDV method, which is the written down value method, on block of assets at rates which have been prescribed under the Act. So there are different block of assets which are there, right? So you've got a block of assets as building, ships, you've got plant and machinery, you've got furniture and fixtures. So all of these are block assets. Then within block assets, you've got certain rates that, well, if the block asset is of this type, then this is the rate of depreciation that we are going to use to calculate the depreciation, right? So you can get deduction courtesy this provision on depreciation under section 32. Then we've got section 37. So you've got a whole list of deductions from section 30 to 36, right? And when you look at all of these sections between section 30 to 36, they are all talking about different types of deductions. Then comes section 37, which is the residuary head for deductions. So what does section 37 do? Section 37 says that, well, if you are looking for some sort of a deduction, first start looking from section 30 onwards. If your case falls under any of these sections between 30 to 36, then great. If not, then approach me as section 37, and if you are able to fulfill the conditions that are provided in section 37, then you can still seek deduction on it, even though there is no specific provision for those deductions under section 30 to 36, right? And therefore we call section 37 as the residuary head for deductions. So it is stated that if the following conditions are satisfied, then deductions may be allowed. What is it? First is that the expense must be of revenue nature. Expense must not be of capital nature. Expense should not be of personal nature or for personal purpose. It should have occurred or incurred in the relevant previous year. So RPY is your relevant previous year. Then we say that that particular expense has not been allowed in section 30 to 36. So if there is a specific provision for that particular deduction that you are seeking within section 30 to 36, you can't approach 37. So 37 is literally the residuary head. If something has been addressed, please go back to that section. If it has not been addressed, then you look at it from the point of view of section 37. So now, for us to be able to understand whether something is of revenue nature, not of capital nature, not for personal purpose, etc., we need to understand these terms in greater detail. So that means expense is of revenue nature, expense which is not of capital nature, right? So let's look at that now. So when we talk about capital and revenue expenditure, we see that all transactions in business, whatever transaction you're looking at, that will either be a receipt or there will be some sort of an expenditure. Now you're going to run a business, right? Either you're going to keep receiving money, okay? So when you're receiving money, that receipt will either be of capital nature or of revenue nature. Or you will have to spend out money. Either you're going to receive money as a part of your business or you're going to spend out money. So when you're spending out that money, that expense can also be of capital or revenue nature. Now if you twist this around, same thing, you just twist it around and you see it from the revenue nature point of view. So we say that in case of revenue nature, transactions of revenue nature, those transactions of revenue nature can either be receipts or expenditures. And similarly, transactions of capital nature can either be receipt or expenditure. It's essentially the same thing, right? So what are we doing? We are grouping this together and forming this part. And then we are grouping this together and forming this part, right? So then we try and find out what is this difference between capital nature and revenue nature expenditure. So for us to be able to find out what is revenue receipt, what is revenue expenditure, and what is capital receipt and capital expenditure, it is best understood when we understand what is capital expenditure and contrast that with revenue expenditure. So if we are able to understand revenue expenditure vis-a-vis capital expenditure, we will automatically understand what is revenue receipt and capital receipt. So let's now explore what is the difference between capital expenditure and revenue expenditure. So in case of capital expenditure, we see that the expenditure that is being incurred, that is usually very high in its volume, right? So let's say, for example, I need to construct a building. If I have to construct a building, that will get me to spend a lot of money. So it's very high in its volume. So usually it's going to be high volume expenditure that I'm looking at. Or I want to set up a factory. Again, there is a big expenditure, right? So when I am looking at such an expenditure for the purposes of my business, then usually I'm looking at a capital expenditure. But then that's not the only condition. Then I see that, well, this capital expenditure or this expenditure which is taking place, that is happening once in many years. So it's not that I'm going to construct a building every month or every year, right? Unless and until that is my business, right? Then when I incur this expenditure, some sort of an asset comes into existence and the life of that asset is 1 year. So I must have some sort of an asset coming into existence. If my asset is not coming into existence, then perhaps I am not having some sort of a capital expenditure. Next is that when this expenditure occurs, then this expenditure contributes to the increase of either the productivity or profitability or capacity or efficiency of the overall asset that I am looking at, right? Then also I can say that there is a capital expenditure. Now if you contrast this with revenue expenditure, revenue expenditure is one which is not of very high volume, not very high. Can be, but usually it is not a very high level expenditure. Revenue expenditure, if you contrast this with capital expenditure, it will happen on a regular basis. So it will keep happening on a regular basis, right? Then you've got any asset that comes into existence and life of the asset is greater than 1 year. So when you contrast this with revenue expenditure, there is no asset that will come into existence, okay? And then finally, we are talking about the contribution to the increase of productivity, efficiency, profitability, capacity, etc. But over here, in case of revenue expenditure, that may not be the case. So for example, I want to go and construct a building, okay? So for that building, I know that there is going to be a huge amount of expenditure, right? And I know that this is a building that I am going to build once in, let's say, 10 years. Maybe after 10 years, I want to bring it all down to ground zero and start again. Then I know for a fact that this asset that I am creating, this building that I am creating, its life is definitely more than 1 year. There is no chance that its life is less than 1 year. And then, of course, it is going to contribute to increasing my business's productivity, efficiency, capacity, profitability, etc. Right? Now, let's say, for example, I already have a building. I already incurred a huge amount of expenditure and it's been 5-6 years, right? Now, after 5-6 years, there is a sudden natural calamity, as a result of which a part of my building actually falls, okay? So, maybe some wall has, one critical wall has gone away because of the natural calamity, and now I need to get that repair work done. So when I need to get that repair work done, this expenditure is not going to be very high when I compare it to the building construction which had initially taken place, right? So let's say, for example, I had spent 50 lakhs making that building. I will probably spend 2 lakhs to repair that wall or repair that room, as the case may be, right? So it's not something that is of a very high nature. Similarly, if I look at it again from the revenue expenditure point of view, it's not something that is going to happen on an everyday basis. It's not going to happen every year, right? Unless and until I just do some sort of a makeshift arrangement, right? Just to stop, let's say, the wind coming in, etc. But it's a very stop gap arrangement that I have made. Nothing that's really solid. Then probably I'll have to keep incurring expenditure. But normally, if there was a wall, if there was a proper concrete wall, I'm going to erect another concrete wall only, right, to be able to carry out that repair effectively. So this is not an expense which I'm going to incur every year. So it's not something that's going to happen on a regular basis, right? Then no asset is going to come into existence, and of course, the life of the asset that we're talking about over here is the building, but no fresh asset is coming into existence, right? I'm just repairing what was already there. And does it contribute to the increase of my productivity, profitability, capacity, efficiency? Nothing much, right? So it's not affected my business as a whole just because one wall has fallen down. Similarly, if I buy a computer, right? So once I buy a PC, and let's say, for example, I have to open up a big business and I go and I buy 50 computers, right? Or let's say I go and I buy 50 printers. When I go and I buy these big quantities of computer systems, including printers, etc., I know that this is an expenditure which I'll have to incur once and then sit down. So it's not that I'm going to keep changing my computers every year, right? And in case something goes wrong with it, what do? I will get it repaired, right? So repairs will probably keep happening, okay? But I am not going to go and change the entire thing. Let's say, for example, I have a printer. So when I buy 50 printers or 500 printers, that's a huge expense. But I will have to keep buying my rims of paper. That's a regular expenditure. Or I will have to keep getting my printer serviced because that is what is required for its regular maintenance, right? So that is also nothing but revenue expenditure. Why? Because that is an expense which is happening on a regular basis. But no fresh asset is coming into existence. So if I'm changing the rim of paper and taking out more printouts, etc., it's not bringing any asset, right? And then it does not really contribute to the increase of my profitability, productivity, capacity, efficiency, nothing, right? It's just maintaining my business on an everyday basis, right? Then we will understand the capital and revenue expenditure from the point of view of two different tests. First test is that of fixed and circulating capital. So when we look at this test of fixed and circulating capital, we say that, well, there is some amount of money which will, of course, you need capital to start out a business, but then out of that huge capital that you are carrying around with you, one part of it will get fixed somewhere. And then one part of it will be in circulation all the time, right? So if I am investing my money in computers or in the printers, my money is going and getting fixed over there. But I also need one part of the capital which needs to keep circulating, which needs to be there in circulation for me to be able to maintain my business. So if I am buying a printer, that is my fixed capital. That is where my fixed capital is going. But if I'm having to buy rims of paper and if I'm having to buy cartridges for the printer, etc., that is nothing but my component which is dealing with circulating capital. So this is one of the tests that we look at to determine whether or not an expenditure is of capital nature or of revenue nature. So this test was discussed in the case of Empire Jute Mills Company, Empire Jute Mills Limited. And then we had another test which came through from the Empire Jute Mills case, which is the test of enduring benefit. So when we look at this test of enduring benefit, we basically say that whatever you are investing in, whatever you are expending your money on, that is going to give you an enduring benefit. That means it's going to give you a very long-term benefits. It's not a short-term benefit that we are looking at. So when we look at this question of whether some expenditure is of capital nature or revenue nature, we need to keep in mind all of these factors. We need to keep in mind what kind of an expenditure is it? Is it a high volume expenditure or one which is not very high? Is it something that is going to occur once in many years, or will it be something that I am spending on a regular basis? Then I will look at the lifespan of that particular asset which has come into existence, right? So I have to look at one, whether the asset has come into existence, and secondly, how long is that duration going to be for me, right? So when we talk about this test of enduring benefit, this is exactly what it is referring to. What is the lifespan of that benefit that we are possibly looking at? Then we have to check whether it really contributes to increasing my efficiency, profitability, etc. If the answer for all of these is in negative, then we know for a fact that this is nothing but revenue expenditure. But if all of these conditions are satisfied, then we know for a fact that this is a capital expenditure. So none of these criteria which are there are something that you can look at in a very fixated manner. You have to look at all of this in a very, very holistic manner. So it's not that one criteria is fulfilled, so I will call it capital expenditure. It cannot happen like that. And therefore, you have to keep understanding the dynamics of whatever you are dealing with. Now, I give you the example of printers and rims of paper, okay? Or printers and cartridges, right? So we know for a fact that if you're investing in rims of paper or cartridges, those are something which are going to be used regularly, okay? So for you, when you bought those 50 pieces of printers, what were they? They were an expenditure which were of capital nature, right? But when a person who's selling those printers, you are buying those printers for your office, right? But you bought it from somebody. You bought it from a dealer who's dealing with printers, and that dealer is buying printers, right? When that dealer is buying these printers, what is happening is that those printers are nothing but raw material, or what we know as stock in trade for that dealer. So you are buying the printer. For you as a business, it is a capital asset. But when you went to that dealer, the dealer also bought the printers. But for that dealer, that is nothing but his raw material. That is what he is there to sell. He is not there to keep it with himself. That, oh, I am not going to sell these printers, right? So when he is going to deal with those printers on a daily basis, he is going to sell them out as the raw material. Then those printers themselves turn into stock in trade, and then we say that those printers that the dealer had bought, for him, the purchase of those printers was nothing but a revenue expenditure. But for you, when you bought those 50 printers from the dealer, it was nothing but capital expenditure. So it really depends that how are you dealing with those particular assets, right? So let's say, for example, you've gone and bought yourself a car. When you go and buy yourself a car, that is an expenditure of capital nature by and large, right? So when you buy that car, for you it is capital expenditure. But you bought this car from somebody who is dealing with hundreds of those cars on an everyday basis, or thousands of those cars on an everyday basis, right? So can we say that this person who's buying those 1,000 cars every day, the dealer who's getting those 1,000 cars every day, that is capital expenditure? No, because those cars are meant to be sold out. When you are going to incur some sort of a capital expenditure, it is with this mindset that this is what I am going to invest in my business, and this is going to increase my profitability. It is going to bring some sort of an asset in existence. But when the cars are being bought in such huge quantities by the dealer, they are not capital expenditure. They are only going to be seen as revenue expenditure. Why? Because these cars are going to be treated as the raw material, or what we know as stock in trade. So any expenditure that you are going to incur on your stock in trade or on your raw material, that is nothing but your revenue expenditure. Because today you've got 1,000 cars as a dealer, you will sell out 500 of them, and because now there's a deficit of 500, again you will order 500 cars more, right? So every time you are going to purchase those 500 cars or 1,000 cars, you can't be having a capital expenditure. That is for you stock in trade. But you as an individual, as a business entity, if you go and buy yourself 2 cars for your business, or as an individual you go and buy 2 cars for your profession, right? That is going to be a capital expenditure, right? So I hope you are able to understand the difference between capital expenditure and revenue expenditure. So we will now look at what are bad debts. So bad debts are basically those debts which you cannot recover, right? Some debts have been incurred and they are such that you are no longer able to recover. And when you are no longer able to recover them, you write them off in your books of accounts for that particular previous year. When you write them off in your books of accounts and you have taken all possible actions to be able to recover them, but realize that nothing is going to happen, then we declare them as bad debts. So let's explore this part. So the eligibility for the deduction is on the existence of debts which are irrecoverable, right? And is totally under the law or through courts. The conditions laid out in the Income Tax Act 1961 under section 36 clause 2 should be fulfilled before any allowance for bad debts is allowed. So you need to fulfill certain conditions, right? So what are those conditions? One is that the debt or the loan should be for the business or profession of the assessee, and the said debt or loan should be for the relevant accounting year. So it has to be for your business or profession. So we are not talking about personal loans, right? And it must be in the relevant accounting year. Any debt which is not related to the assessee's business or profession, in that case deduction will not be allowed. Then in the case of Girdhari Lal Gyanchand versus CIT, the court had said that it is settled that if a debt due from retired partners is irrecoverable, then the assessee cannot write off and claim the same as a deduction since it is a capital loss. Then an assessee can take the deduction in respect of those debts only which have been included in the computation of income tax return and in the current period or any previous financial year. In case of money lending business, the money lent in the ordinary course of business should be considered. Then the deduction claimed as bad debts against any debt or loan or any part of it thereof should have actually been bad in the accounting year, right? So you've just not been able to recover it in that particular year. Then an assessee will only be eligible to take the deduction in respect of those debts which they have written off from the books of accounts in the previous financial year in which the deduction is also claimed. So that is the concept of bad debts. Let's look at these two cases. First one being LB Sugar Factory and Oil Mills Limited versus CIT. So over here what had happened was that there was this entire setup, and over here there were these different factories which were there. And now there was a dam which was being constructed and there were roads which were also being constructed, right? So over here, let's say for example, this is LB Sugar Mills, right? So if this is LB Sugar Factory and Oil Mills and these are the other people, they all had put in money, they all had contributed money for the purposes of this road to be built in and around wherever they were located. And LB Sugar Mills had also, so it had made two sort of contributions. One towards the construction of the road and the other one was towards the construction of the dam. And now the question was that can we call this expense which they had incurred on account of contribution towards the road construction and the dam, could they be considered as capital nature expenditure or revenue nature expenditure? So when you look at this particular case, the court said that if you have gone and contributed to the construction of the dam, the court said that okay fine, let's understand whether this is of capital nature or revenue nature. What do we find out? Did some asset come into being? No. Did it create anything? Did it increase the profitability, efficiency, productivity of the business? No. Was it an expense of very high volume? No. Was it something that has probably occurred or will probably occur once in many years? Maybe yes, that is possible, right? But at the same time, So it has not really created any fresh asset. It has not, maybe it's an expense that you're going to incur once in many years, but it's not creating any fresh asset for you. It's not something that is going to increase the profitability, productivity, efficiency, etc. of your business. So the court over here said that, well, as far as the contribution towards the construction of the dam is concerned, that is nothing but an act of good citizenry. So the court said that we don't see it as capital expenditure, we don't see it as revenue expenditure either. It is nothing but an act of good citizenry, full stop. Now, coming to the expenditure which was incurred by LB Sugar Mills on the road construction. So the court said that, well, where the road construction is concerned, this road which has been constructed, you have only contributed to it, right? You have contributed to the construction of the road. Now, if you contribute towards the construction of a road on a regular basis within your premises, we may say that, well, it's a capital expenditure. But over here, is it that LB Sugar Mills had constructed the road only for itself? No. There was contribution from the government as well. There was contribution from all of these other factories which were there. Factory number 1, 2, 3, 4, 5. Right? And LB Sugar Mills being the 6th one. So when all of these factories or all of these enterprises situated over there, if everybody contributed together with the government to construct a road, where is the question of capital expenditure? Where is the question of even revenue expenditure for that matter, right? So the court said that if you look at this contribution that was made by LB Sugar Mills in this particular case, the court said that this is nothing but of revenue nature and definitely not of capital nature, because you have not created any asset for yourself. It may increase your profitability and efficiency, because obviously better roads facilitate better transportation, right? But you are not the only one contributing to it. So you have not created an asset just for yourself. There are other people also who have contributed together with the government, right? And so you might have to incur some sort of an expenditure probably even later on, right? So it's definitely not falling under the category of capital nature, and that is how we see that it was nothing but an expenditure of revenue nature. Now coming to the case of Bikaner Gypsum Limited versus CIT, over here there was this construction or rather there was mining that was taking place of gypsum. And there was a railway track which was being constructed. So when this particular railway track was being constructed, now the problem was that Bikaner Gypsum as an entity, it had 45% share of the state government. And this was supposed to supply gypsum to Sindri fertilizers. And this is a Government of India undertaking, right? So they had entered into the land, right, and this was a land which was leased out for the purposes of mining. So over here the gypsum mining was supposed to be carried out. Now the thing was that railway was going to lay down its tracks, and because it was going to lay down its tracks, they were entering into this land, and because they were entering into this land, obviously it was going to create problem for mining. And as a result of this entering of the railways into this area, mining was becoming problematic, and not just that, there was also a little railway settlement nearby. So it was proposed that, it was rather suggested that this particular tracks be shifted ahead, right? They should be moved ahead and not be there on the land. and this became a matter of dispute. So when this matter became a dispute between the state government and the central government along with Bikaner Gypsum, so all of them went ahead with a negotiation. And when they went ahead with a negotiation, it was finally decided that all of them are going to contribute about 1/3 each for the removal of these tracks elsewhere, right? So that this mining activity can carry on. Now this thing had to be shifted, it had to be moved a little, right? Now when they were going to move it out away from this particular piece of land, obviously there was going to be some expenditure. Now when this expenditure was to be incurred or when it was incurred, Bikaner Gypsum took the contention that this is a revenue expenditure. Now why does everyone want to show it as revenue expenditure? Everybody wants to show in every case that something is revenue expenditure. Reason being that you get deduction on that. If you show it as capital expenditure, you're not going to get deduction. So if you want deduction, you always have to show it as revenue expenditure. So again over here the fight was to show it as revenue expenditure. So now when everybody had contributed equal amounts to the removal of these tracks, the court came to the conclusion that over here you are not creating any fresh asset for yourself. What are you doing? You are only removing that obstacle away. So your obstacle now was those railway tracks. And when you remove those railway tracks from there, you are not creating any fresh asset. You are not doing anything that is, something that will bring into existence some sort of a fresh asset, right? And therefore, the court said that this is nothing but an expense which is of revenue nature and not capital nature. So with this, we end our lecture on profit and gains from business and profession. I hope you all have been able to understand very, very clearly the most important bit, which is the difference between capital nature expenditures and revenue nature expenditures. Thank you.
Hello, I am Professor A.K. Sharma and I teach sociology in IIT Kanpur. I am taking up a question, what is world population crisis? World population crisis refers to explosive growth of population which occurred during 1950s and 1960s. For millions of years, some people estimate that perhaps man appeared on this planet Earth 5 lakhs years ago. It took these 5 lakhs years for world population to reach first billion in 1820 AD. And that means that the population in ancient times must have been rising at rate 0.000 something percent per year. Now in 1950s and 1960s in the world, you find that population started growing at rate more than 2% per year. This is what is meant by population crisis. You can imagine that if a population grows or anything grows at 2% per year, then in about 35 years time it can double. And obviously, particularly in the context of less developed countries, it had implications for poverty removal, for employment generation, for maintaining health, improving life expectancy, raising educational levels, etc., etc. The reason behind this population crisis was improvement in life expectancy or improvement in general health standards of populations. You may not be knowing, or you will be surprised to know that about 100 years ago in our country, life expectancy means average age of death or average age of life, whatever you say, of a newly born child was only 20 years, and today it has reached the level of 68 years. Much of this improvement in less developed countries occurred in 1950s and 60s, and therefore, with improvement in health, improvement in life expectancy or average age of birth, average age of death, and population started growing at explosive rates, and people started writing about this. This is population explosion, or this is population crisis. And now one can say that the period of peak growth rate is over, and from 1971 onwards, in the world as well as in our country, growth rate of population has started declining. Now, in India, you may like to know what is the current growth rate of India's population. Currently, India's population is growing at 1.5% per year, and the reason is that after sudden or unexpected improvement in health conditions in 50s and 60s, which led to population crisis, we find that today average number of children has also started coming down. So, there was a time when average number of children per woman was around 11 or 12, now it has come down to 2.5, and therefore, the growth rate of India's population has come down to 1.5%, and we can hope that in the future, means in the coming decades, even if nothing changes on the front of fertility or number of children, India's growth rate of population will decrease further and eventually come to a zero level, as said by the 11th 5-year plan of India. And now the major cause of high growth rate of population is not high fertility, but the age distribution of population. So, we have a high percentage of population at the younger ages, and that is the cause of high rate of growth of population. Eventually, when population of India will also age like population of other developed countries, our growth rate will start falling. Thank you. Now, we will meet in the future.